what do you call it? You can just show of hands. Okay, how many of you think developing a strategy for your business is important? Okay, give me, I can't see you by camera, so show me the hands. Yeah, so okay, I have 3 out of 26 out of 20 some, so just a fraction of you think developing a strategy for your business is important. Okay, and maybe the rest of you are in the wrong class. Okay. All right. Okay. All right. So okay. Okay, 4 more. All right. So that's good. So most of you think developing a business strategy for your business is important. So let me ask you another question. All right. How many of you have a written strategy? I'm actually seeing most of the hands, but welcome to use the chat box. Okay. So this is what I saw, and maybe I missed some of you, right? This is what I saw, and that is almost all of you think developing a business strategy is important. And then just a couple of you, okay, raised your hand on the fact that whether you actually have one written. A lot of people say they have one, and then when I ask them, okay, do you have one written? And they'll say, no, it's in my head. You know how that works. If it's in your head, it's pretty loose and sloppy, right? So there's a gap between what we know we should do, which is actually have a strategy for your business, and then actually doing one, right? So I want to address that question, right? Because this is so common. So common for us to, for business owners and leaders to know that we should, but then we don't do it, right? Okay. So let me make a generalized statement, okay? I know some of you, I don't know many of you, but I know why you're here this morning on this beautiful, right, Friday morning. And you're here because you got nothing else to do, right? You have so much time in your hands. so you decide to just log on a webinar, right? No. You're a business. If you're in business, you're business owners, business leaders, you are busy, right? Okay, so then why are you here, right? Okay, so here's what I suggest. Okay, and I'm going to use a language, and you're going to have to translate it a little bit. I suggest the reason why you're here is because you're not as happy as you want to be. Okay, let me just change that wording. Maybe you're not as fulfilled as you want to be. Maybe you're not as satisfied as you want to be. Something like that. Because if you are happy, satisfied, fulfilled, you'll be doing that thing, right? But the reason why you're here is because you're not. And so the reason why you're here is because you want to get to that happier place, a place where you're more satisfied, fulfilled, okay? So if that's the case, then you need a plan to get there. You need a strategy to get there, right? The only reason you need a strategy is when you are not happy with how things are, right? I'm talking about business now, right? You're not satisfied how things are. That's when you need a strategy, right? Okay, so did you know that some 80% of strategies fail or really does not deliver what everybody had hoped, right? Did you know that? Okay, I come from consulting, so this is the kind of the dirty laundry, right? Most strategies and plans fail, right? So then you got to ask, okay, well, how come so many of these fail? I suggest because ultimately, when you're doing a strategy, it ultimately ends up in someone changing their behavior. You got to do something different, right? So how easy is it for you and me to change our behavior, right? It's not easy, right? So ultimately, plans and strategies come down to someone doing something different, right? So the problem with most planning and most strategy development is most people begin planning with planning. You begin strategy by developing a plan. And I suggest to you that's just not powerful enough to change behavior. Okay? It doesn't give you the impetus to go and do the hard things, right? So I suggest the missing ingredient in making a strategy more successful is actually the destination. What is it that you want that's worthy of hard work, right? To do something you've never done, to do something that you don't like to do, right? The only way you can actually put that into practice if you have a goal or a destination that is so much better than where you are, right? So I'm suggesting when you build a strategy, you need a destination first. You want to get to someplace better, right? And we can call it objective, you can call it goal, right? So I'm saying that is the number one most important component of a powerful business strategy. Okay, once you have that, then you got the marketing strategy, which we covered last week. All right, most people think marketing is advertising. Actually, marketing is actually an execution of a clear business model. Okay, what's a business model? Business model, if you took it last week, if you didn't take it, you got to take it because that is so important. It's really about the clarity of the problem, size of the problem, and the power of your solution, right? And all of those things, right? And the marketing strategy is executing on that business model. If you don't have one, which most businesses don't have one, you're gonna basically have a cylinder engine trying to go up Mount Spokane. You're just not gonna make it, right? Put. You need powerful engine, which means you need a very powerful, clear business model. And that's what we covered last week. And then after that, that's the engine, right? And then we're talking about today, financial strategy, right? And most people think finance is about paying taxes and bills, and we'll talk about what actually it is. And next week, we're going to talk about operations and management strategy. Operations is about how to deliver the value proposition, how to deliver the wow, how to deliver the goods, how to deliver the win, okay? Morning, noon, and night. When you do it, when your employee does it, when you are tired, in the evening, Saturday afternoon, at the end of the week, how to actually deliver that. And this is probably the weakest area in most businesses. And you won't find this topic covered anywhere else. This is worth just so much. So I suggest that, right? And then next week, and then management. And ultimately, your number one competitive advantage is your people. And you got to figure out how to lead your people well, all right? How to hire the right kind of people and so on. And then that's next week. And then the week after that is digital strategy. Online strategy, as you know, is now essential for business success. Okay, so these are the topics we were tackling starting last week and to the end of the month. Okay, so today we're talking about financial management for profit. Okay, so how many of you feel like you understand financial statements? Okay, good. Okay, all right. So that's kind of what I expected. All right. So what's it for? Okay, good. Deborah, looks like you're helping lots of these business owners, business leaders. So good. So what's it for? What are the financial statements for? Right? Okay, measure success. Okay. Okay. All right. So let me ask you, who put together these who built these financial statements? Okay, thank you, Kelsey and Tammy. So who built these statements? The P&Ls, the balance sheets, the cash flow statements? Who put it together? Okay. Okay. QuickBooks, the owner, me, bookkeeper, me, NCPA, Board of Accounting. Okay, right? Well, actually, you didn't design it. You're using something that was pre-designed, right? Okay. And so who designed it? Right. Okay. So if you think about it, okay, it's the CPAs, right? It's the CPAs. And then they use it, bookkeepers use it, you use it. And what do the CPAs care about? What's your accountants? What do they care about? Okay. Okay. Accurate numbers, cash, bottom line. Okay. Making book, pass, IRS. Okay, very good. Okay. Really, if you think about it, the number one liability for CPAs, the tax accountants, is really paying wrong amount of taxes, right? That's their liability. So number one concern they have is making sure they pay the right amount of taxes. And then for your bookkeepers, right, their number one concern is paying bills, right? So let me ask you, okay, I'm assuming I'm addressing business owners and business leaders. Is that your number one concern, paying taxes and paying bills? Okay, okay, very good. Cash flow, no. Making profit, no, okay. Right, very good. So your number one concern, I mean, obviously you want to make sure the taxes get paid, but your number one concern is in paying the right amount of taxes, because you assume your CPAs and bookkeepers will do that. But you're trying to build a business that's hopefully profitable, right? Is that right? Okay. Which means you need different kind of metrics, right? So why financial statement? Okay. Because chances are, how many of you have more money than you know what to do with? Anybody? I'm waiting to have somebody say, yes, I have more money than what to do with. Not yet, someday. Okay. Okay, very good. So what you just told me is you have scarce resources, right? You have limited amount of funds, and you can't spend it any which way. You got to spend it the right way if you want the kind of results you want, right? So why we use financial statement is because you have to manage a limited amount of resources. And those are not only dollars, your employees' hours, right? And so you're trying to manage a limited resource. And the second thing is you're trying to get to a better future. You're trying to get to a destination. And if you have limited resources and you're trying to get to a destination, you better use that limited resource very, very well. And you need intelligence to help you to make sure that how you spend it, where you leverage it, where you invest it is in the right places, right? So to achieve an objective. And then lastly, I know many of you are trying to make a living, right? But that's because you are maybe in the early stages, earlier stage of your business. But at some point, you're going to probably exit. And according to research, some 80% of small business owners' retirement is tied up in their business. Did you know that? So when you exit, when you transition your business to your employees or to somebody else, that's really gets your wealth, your retirement wealth out of your business. So you want to increase the value of your business so that when it's time for you to exit, you can exit well, right? Which means you have to create value in your business. And I know some of you are in the early stages, but it's so helpful to have that in your mind, right, as you are building your business. Okay, so why financial statement? Because you got limited resources. Because you're trying to achieve, trying to grow the business and achieve a goal. And then you want to create value in your business. All right, so here's what we're going to talk about today. Income statement. Cost of goods sold, gross net profit, profit margin, break even, cash flow projection, and income statement projection. Okay, so let me ask you, what's the difference between big business versus small business? Okay, adapt quicker, amount of cash, they can take more risks, more people, investor, capital, public. Okay, so would you agree that the strength of a big business is that they have deep pockets, lots of resources, right? Skills, right? But number one thing is they have deep resources. Would you agree? What's the number one weakness of a small business? The other side of that, right? Small business, you have lean, lean resources, limited, right? Okay. So what's the weakness of a big business? Okay. Slow moving, red tape, overhead, entrenched, change is difficult. Yeah, you get it, right? They're slow. Big businesses are slow, right? So what's the number one strength of a small business? Me. Okay. Adaptability, quick to adapt, buck stops with me, customer service. Okay, maybe. Okay. So here's what I suggest, personal touch. Here's what number one strength of a small business really is speed. Speed, right? You can change right now. You can change again an hour from now. You can move really, really fast, right? Okay. So weakness of a small business, you don't have deep pocket, you're lean. Strength of a small business is you are fast. So what happens if you don't have the intelligence that you need, right? So the way you respond, because you don't have the intelligence, so the way you respond and the way you move is like the federal government, right? You don't get your numbers until the end of the year. You don't get it until 3 months later, right? 2 months later, so that the speed with which you respond is nullified, right? By lack of intelligence. And this is the dilemma of so many small businesses. You can be fast, but so many move so slow, right? Because they don't have the intelligence to move quickly. Okay, so financial statements must be timely and accurate. If you're getting your financials and it's a month behind, 2 months behind, 3 months behind, 6 months behind, end of the year, okay, you have no way to respond, right? It's too late. And if it's not accurate, right, if you don't trust it, you won't move. You won't make the decisions. So if it's not timely and accurate, you just nullified your number one strength. So financial statements must be timely and accurate to be useful in making decisions, timely decisions, powerful decisions, right? Okay, so let's begin with income statement. All right, okay. So this is the first statement, first tool, income statement. It's referred as profit and loss statement. Okay, profit and loss. And it should include, right, your company's primary operation. So here's what I see sometimes. I see businesses who have maybe multiple other type of businesses. Maybe they have some rentals. Maybe they're doing some other kinds of leasing or selling, and then it's all kind of all put into one profit and loss statement. Okay, so let me ask you, how accurate and how clear will those numbers be for you to be able to make a effective decision? Okay, okay. So what you want in your P&L is you want to separate out the different businesses. You don't always have to break it out into separate legal entities, but QuickBooks allow you to have multiple businesses. Some of you may have different business units. So some of you are doing maybe leasing, some of you are doing sales of the same kind of equipment, and then those are different kind of businesses. You could set up different departments within QuickBooks. So so you want to organize your books in a way that gives you the best intelligence so that you can make speedy, effective decisions, right? All right. So there's a kind of a very, very simple equation. Revenue, which is sales, minus total expenses gives you either net income or net loss. This is such a simple, right? Revenue, which is sales, and all your expenses should give you net income, right? And you want that in a positive, right? Okay, so let's break it out a little further. So I'm assuming you're all familiar with sales, right? So when we look at the businesses' P&L, income statements, usually we see one line for sales. Sale is one line, okay? Is that good or bad? Okay, I see bad, bad, bad. Depends on what you need to track. Not accurate, could be more accurate. Very good. Okay, all right. So let me ask you, are all revenue the same? Are all sales the same? Why or why not? Are all your customers the same? Okay. Do you generate same amount of profit out of all your customers? Okay. So that's the point, right? You're not all customer are same, not all sale is the same. But if you have one line for that, it nullifies your ability to move, right? It nullifies your ability to gain intelligence to make this better decisions. So if you want more of a certain kind of sales or more of a certain kind of customers, right? Don't you want to see it? Don't you want to track it? Don't you want to see that number move, right? So I suggest, right? You should have multiple lines for sales, depending on what you want. So give me an example. Some businesses, maybe you're doing residential, you're doing commercial, you're doing government, or something like that. So you may have three different ways to categorize your customer base. So let me ask you, are all residential the same? And chances are, no, not all residential work is the same because you got different type of residential work. Are all commercial work the same? No. Some are more profitable than the others. So the point of this is you should know what you want to track, which needle you want to move, and then it should be reported so you can see it every time you look at it, right? So that you can grow it to the degree that you want. Okay? All right. Very good. Repeat customer versus one time. Yes. So you know, it's I don't know what kind of businesses you all have, but if you have to get new customer and you do one-time sale and you have to get a new one over and over again, that's a pretty expensive business because acquisition of new customer is difficult, costly. If you can keep the customers that you have and you have repeat business, that's a beautiful model. So do you want to know how much of your sale is coming from repeat business versus new customers? Excellent point, right? Very good. So again, the point of this is, what is it that you want to know so that you can grow it? What do you want to grow? All right, we're moving to cost of goods sold. So what's cost of goods sold? What's cost of goods sold? All right. So cost of goods sold, it's a funky title. And I know anytime you get into a particular, you know, one of the challenges of getting into learning about financials is the language. But actually, once you get over it, it's probably not as bad as we think. So cost of goods sold, cost of goods sold. So it's cost of all the things that you have to pay for in order to deliver on the sale. So what's included in something like that? So it could be raw materials, direct labor cost, sales commissions, could be freight, could be shipping, maybe it could be marketing, right? So let me just clarify what I just said, cost of goods sold. So in order to generate $1 of sale, chances are you had to do something to generate, number one, the sale. And then now there are some things you had to do to deliver on the sale. So if you're delivering, if you're producing product, you got things like what we just talked about, raw materials, the labor cost to build it, and then you got to ship it, and then if you have a salesman, there's sales commission, and so on. If you're doing a service business, okay, so there is cost of actually generating the sale and then delivering on the service to fulfill on that sales, right? So for every dollar that comes in, right, what are the costs to generate the sale and then fulfill on that sale? Now that's called cost of goods sold, okay? So why is cost of goods sold important? Well, we'll find out here real quick, all right? So again, let's say you have a business and you have two type of products, product one, product two. So first one is 350,000, second one is 125. Your gross sale is 475. You got some returns and you got some discounts and so on. and your net sale is 438. Okay, but that's just sales, right? And then what's your cost of goods sold? You got material cost, you got labor cost, you got freight, and therefore your cost of goods is 297. Okay, so you for generating for sale of 438, it's costing you $297,000 to actually fulfill on that sale. Okay. All right. So what's the next item? Gross profit. What's gross profit? Right. Okay. It's sales minus cost of goods sold. Right. Sales minus cost of goods sold. Okay. So I just said cost of goods sold is, okay, for every dollar that you generate in sales, how much did it cost you to generate the sale and to fulfill on that sale, right? Did it cost you 30 cents on the dollar? Did it cost you 50 cents on the dollar, 70 cents on the dollar, 90 cents on the dollar, right? So depending on how much it cost you, what's left is called gross profit, right? And why is gross profit important? Because out of gross profit, you cover your overhead and you generate profit. So most businesses focuses on sales. When we talk about goals, most business default to sales, right? The problem with focusing on sales is if your goal is sales, you'll chase all kinds of sales, all kinds of business, right? Problem with that is not all sales are the same. Some sale gives you very low gross profit. Other sales give you lots of profit. And then when you have one sales number and all the cost of goods pulled in, right? And then you get a particular number, right? But you don't know which business, which customer really is generating much of the gross profit. Because name of the game in business, when you look at your financials, you may have 2 pages, 3 pages, 4 pages of financial statement. In most financial statement that I see, the sales, cost of goods, and gross profit section takes about maybe quarter of 1 page, and rest are all overhead, right? Expenses, list of expenses. And okay, but the name of the game of most businesses is really in your sales, in your cost of goods, in your gross profit. That's really the part that you can make the biggest difference in how you run your business, right? Which kind of customers you go after, how you manage your cost of goods to generate the maximum gross profit that you can. Because out of that, you cover your overhead and generate profit. Okay, and I suggest gross profit really, this is how you build your future of your business, is really based on gross profit, not based on sales. All right. So again, we have the sales. We just saw that before. And then you got the cost of goods sold. And then you got the gross profit. All right. So 438 minus cost of goods sold of 297 gives you gross profit of 141. Okay. Any questions so far? How do we know what a good gross profit number? Very good point, right? That's a good question. Sarah, will you hold off just a bit, and we'll cover a little more, and I'll come back to it. Okay. There's no magic number, but there is there is no magic number. It depends on your industry, but there is a way to, I would say, really look at your business where you have sufficient gross profit that will generate healthy profit. And that's what we're after. So let me unpack it a little more. Okay, so we're gonna do an exercise. All right, so I'm gonna give you 2 minutes to do this exercise. So this is why you need paper and pencil, right? So this is a cost of goods sold for each t-shirt, right? A company selling a personalized t-shirt for 10, cost of the t-shirt is 3. Labor to personalize is $1 per shirt. Commission is $1. Shipping cost is $500 for 5 boxes at $100 on 100 shirts per box. Facebook ad, bookkeeper, gas to take package to retail store, insurance. And then, so I want you to figure out what is the cost of goods sold for each t-shirt and assume 1,000 shirts are sold every month. Okay, so I want you to take your paper, pencil, and go at it. You got 2 minutes. So I want to encourage you to give it a go, okay? The more you engage and more you work it out, it'll help you, because this is, the exercise will be progressive. So engage and do your best. So the exercise on the screen. Jason, that's not relevant for your solution. Okay. All right. So let me, why don't you put your, if you have the answer, why don't you go ahead and put it in the chat? What'd you get? Okay. Anybody else? Okay. Okay, anybody else? I see 7,200, 9,200, 8,700, 9.2. All right, let's take a look. All right. So, company selling personalized t-shirt for $10, right? Cost of t-shirt is $3. Labor to personalize is $1. Sales commission is $1. Okay, a shipping cost is $500 for 5 boxes at 100 shirts per box, which means $1,000 for 1,000 shirts, which is what they sell in a month. Facebook ad is $600 a month. Okay, so let's start with those. Shirt is $3, labor is $1, commission is $1, shipping cost right? It comes out to $1,000 for 1,000 shirts, so it's $1 per shirt. Facebook ads, $600 a month, divided by 1,000 shirts a month, gives you 60 cents. Okay, if you chose, so bookkeeper, does the bookkeeper wages go into cost of goods sold? Okay, all right. So does bookkeepers' hours, when they do the AR, AP, and so on, does that actually affect delivering on the sale, generating sale, delivering on the sales? Right? No, because they're overhead. Okay, gas to take the package, $200 a month, divide by 1,000 shirts, gives you 20 cents. Insurance is $1,200 a month. Does insurance affect generating sales and delivering on the sales? Answer is no. So that's overhead as well. So your total cost of goods sold is $6.80. Okay, $6.80. Okay, so remember, cost of goods sold is what did it cost you to generate the sale and deliver on the sale, right? For every sale that you generate. Okay. Is the bookkeeper an employee, or does it matter? Does it matter? Does the bookkeeper affect generating sale and delivering on the sales? Now that's the question, right? So bookkeeper is like your front desk person or your HR person, right? Okay. All right. So, okay. Any questions? Okay, let's move on. Okay, so we're going to shift from gross profit, we just talked about gross profit, to gross profit margin. So what is margin? For each dollar of sale, the amount remaining after cost of goods sold to cover operating costs and generating profit, okay? That's your gross profit, right? Gross profit is expressed as $1, right? So we just did that. Sale is per shirt is $10. Your cost of good is $6.80. So your gross profit is $3.20. So what's gross profit margin? What's gross profit margin? Okay, gross profit margin is really the same thing expressed not as $1, but as a percentage. Okay, so gross profit is $3.20 per shirt. Gross profit margin is 32%. How do I get that? The $3.20 of gross profit divided by sales, it's always divided by sales, gives you gross profit margin as a percentage. So why do you care about gross profit margin, or it's called gross margin? Well, the thing is, let me ask you, are your sales the same every day? Do you sell the same stuff, right? Same mix of stuff every day? Chances are no. Your sale is different every day. You sell different mix of stuff. And so Monday may be low, Tuesday may be high, Wednesday may be average, Thursday it goes up, Friday goes up higher, Saturday it's your best day of the week or something like that. So your sales number is going up and down, and therefore your gross profit number is going up and down, right? So as your sales number is going from, let's say, $520 to $700 and $900 and $122, and then you're generating a certain amount of gross profit. How do you know that gross profit number is good, is what you want, right? When you're looking at the dollar and the number is going up and down, it's really difficult to tell. But you may have an optimal gross margin you're shooting for, you're looking for, no matter the dollar sales, right? No matter the dollar sales, when I'm hitting 32%, I know we're in good shape. We're going to hit our goal. But if that gross margin slips and you go down to 25%, 26%, okay, then you know something is not working. And that number, regardless of what the sales dollar number may be, that number is the indicator of your performance, and it's giving you intelligence to say something is not working well, right? It's like a flag. And then you can look at it to say, okay, what's going on? Why did that cost of goods sold number go up? Did the labor go up? Did somebody have to work overtime? Did we have to go back and fix something that we already did? So we actually doubled the amount of labor, right? Or somebody messed up in the production and really, so a lot of the material that we used had to be thrown out because it was ruined, and you had to use a lot more material than you thought, right? So when you look at the dollars, you may not know exactly whether it's good or not, but when you look at the margin, it's giving you a flag, right? It could be a green flag, it could be a red flag. Does that make sense? Any question on that? All right. Okay, so looks like this. Remember, we saw this before, your sales, and then you got the cost of goods sold, and then your gross profit of 141. But what we are finding out is that 141 is 32% of 438. So what does this tell us? What this tells us is out of the sales, cost of goods sold took 68%. Okay, for every dollar that came in, 68% was used in the cost of goods sold, and I have now 32% left to cover my overhead and generate profit. Okay. Oops. All right. Okay. So let me shift gear just for a moment, because this comes up on occasionally. How many of you, let me ask you, because I may not cover it, depending on how many of you use this, how many of you use markup? Quick show of in your chat. Anybody use markup? No? Going once? Going twice? I'm looking for yes. Okay, all right, okay. So then let me just do that real quick. Okay, markup, what's markup? Markup is percentage increase over cost of the material that a business will sell a product or do a service. Percentage increase over the cost of the material. So Keystone is double, and then you got 200%, 300%. The question is markup effective, right? So let me do an example, right? Relationship between markup and margin. I'm using an example. Material cost is $10, and markup is 300%. What is the product price? And what's gross profit and gross margin? All right. So material cost is $10, markup is 300%. So let me ask you, okay, put it on the chat. What's the product price? Quickly. Okay, okay, all right, very good. The product price is actually 40. So this is okay, right off the bat, we got a problem, right? Because there is this bit of a confusion, because 99% of the time people get the price wrong based on the markup. So it's actually, if you remember, 100% would be 20, 20% would be 30, 300% is 40. So sales price is 40. So material cost is 10, right? And therefore your perceived gross profit is 30, right? And therefore perceived gross margin, right? $30 over the sales price of 40 will be 75%. That's the perceived gross price, gross margin. But let's actually do it the right way, right? Material cost is 10, markup is 300%, so the product price is 40. Sales price is 40 minus the actual cost of goods sold, right? Not just the material cost, but the labor cost, shipping cost, sales cost, right? Freight cost, all of that, when you add it up, your cost of goods sold is actually 30. which means your actual gross profit is 10, which means your actual gross margin is 25%, not 75. I had a furniture manufacturer that came in. He had, doing multi-million dollars, and he came in because he was frustrated because he didn't have cash flow. He didn't have margin. So when he came in, he brought his financials. So I asked him, so what's your margin? And he said 73%. And I said, wow, I'm impressed. He knew the number, right? So I look at his financials, and his financial says 22%. So I said to him, this says 22%. And he goes, it can't be right. So I asked him, do you trust the people who put it together? And he said, yes, I do. Okay, so we looked at it, and really at the end of the day, right, what he was thinking is markup, not margin. So he's thinking his margin is 73%, so it should be lots of profit left. But the problem is his margin was actually 22, not much left to cover overhead, generate profit. So again, right, markup is cheap and dirty. It's for people who don't understand financials. So it's confusing, it's inaccurate, right? So I'm suggesting be clear. Margin is clear and accurate, right? And so use the proper the numbers. All right, so we talked about revenue, talked about cost of goods, talked about gross profit, gross margin, and then the next thing is operating expense. What's operating expenses? All the cost incurred in operating business not directly related to the production of the company's goods or selling costs, or it could be delivering the service, right? If you have a service business, it's all the cost that's not directly related to delivering on the service, right? So all the costs incurred in operating the business not directly related to generating a sale and delivering on the sale. So what would that include? Administrative salaries, front desk person, office manager, bookkeeper, right? HR person, insurance, utilities, interest, rent, and so on. Okay. So the difference is in cost of goods, every time you have a sale of one, let's say even one unit, your cost of goods goes up. When you sell 100 units, your cost of goods is multiplied by 100. Your overhead expense, like operating expense, regardless of whether you're selling 10 or 100, they remain stable, right? Your rent does not change, right? Your administrative salary doesn't change. Your insurance doesn't change, right? So your overhead expenses or operating expenses, right, are the monthly costs that you pay regardless of amount of sales. Okay, all right, so we've seen this, the sales, cost of goods, and then your operating expenses or overhead, right? And advertising, marketing, depreciation, freight, rent, supply, other supplies, and so on. And your operating expense here is 125,000. Okay. Any question on that? This part should be pretty straightforward. And the last item we're going to cover is net income, right? What is, okay, I'd like to hear from you. What is net income? Do you care about net income? Okay, reinvested or taken as owner's pay, bottom line. Okay, it's kind of interesting. Okay, sales minus cost of goods minus overhead, because they're very good, Louis. One of the things that I find when I talk about net income with business owners is there's a little bit of, I would say, I don't know if insecurity is the right word. There is a little bit of concern about appearing greedy, right? Talking about net income, appearing greedy. But here's what I say, right? Net income is the measure of excellence. Net income is the measure of excellence for all businesses, right? No matter what you think, how great your business is, because everybody tells me their business is great, right? They're amazing. But if it is, it shows in the net income, okay? So net income is sales minus cost of goods sold, that gives you gross profit, minus operating expenses gives you net income, right? Another way to look at it, we just saw this. So gross profit minus operating expenses gives you net income of 15,600, 4%. That's 4% of your sales, right? Is that good or bad? Okay, we'll talk about that in a moment. Another way to look at it is, okay, all right. So, okay, and we'll touch on the whether that's whether that's good or not. All right, we'll touch on that in a moment. So this is one way to look at your financials. Some of you may not have cost of goods. Most of you have a lot of these expenses. A lot of your cost of goods buried in the expenses. So usually what I see is you have a sales of line or two, and then you may have one line of cost of goods, and then everything else is buried in the expenses. The problem with that is it's really hard to optimize your business when everything is buried in the overhead, right? So I don't know for every dollar that sale that I generate, whether it's costing me 30 cents to deliver on the sale, or 70 cents to deliver on the sale, or 90 cents to deliver on the sale, because it's all kind of just all buried in the overhead. So it's really difficult to improve the performance. So the way you wanna get better at getting intelligence is moving your cost of goods into its own category. So that begins to give you an indicator of what kind of business you actually have and what opportunity you actually have. For example, if your gross margin is 30%, that means that's all you got. 30% is all you got to cover your overhead and generate profit. If you have the gross margin of 30%, right, it's difficult to generate net profit margin of 20%. You may generate single digit. It's going to be hard for you to generate double digit. If your gross margin is on the other hand is 40% or 50%, you have a lot better chance of generating double digit net profit margin. Does that make sense? Okay. All right. So I had a client business that came to see us, and it was a 70-year-old business. And they spent about, it was 2 generations, and they spent about hour and a half talking about what a great business they had, right? All their history and so on. And then I said, okay, great, wonderful. Why are we here talking? And I asked for the financials, and I looked at financials, and what the financials told me was they were living on 3% net, right? For the past 20, 30 years, 3% net, okay? Now, so what that tells us is that they are profitable, barely, right? And so, right? But it's a very old industry, very old company, and so I asked them, so why am I here, right? Why are we talking? And basically, the parents wanted to retire, and there wasn't enough left, right, to pay off the parents and to support the business, right? There wasn't enough margin. So long story short, right? So this is a very old company, and they told me the industry lived on 3%, 2 to 3%, right? A very old industry. And so long story short, I asked them if they were willing to make the changes that would deliver better net income margin. And they said yes. So let's see. So about 4 years later, right, they were hitting 18% net income margin, right? They went from 3% to 18%. Mom and dad were able to retire, now in their third generation. So there is no magic number, right, of what that should be, gross margin should be, what the net margin should be. But if you want a thriving business, you need that gross margin, right, that gives you double-digit net margin, net income margin, right? Because at a single digit, it's doing okay. When you get into double digit, then you are into building a high-performing business. So that's kind of a general statement. I'm happy to go one-on-one and answer some questions on that. So again, this particular presentation, right, is better than maybe what many of you have. So let me show you another way to look at it. All right. So this is what we just saw, right? Sales minus cost of goods sold gives you, and then you got overhead, and then you got operating expenses of 125 and operating profit of 15,000. So this gives me a certain amount of intelligence, right? Okay. And one of the things that I see often is advertising and marketing is in the expenses, right? And I just gave you some hints in the other slide. Should that be in the expenses? And I'm suggesting, okay, you can argue in different ways, but I'm suggesting if your advertising generates sales, right, then it should be in your cost of goods sold. Okay, let me say it another way. If you don't advertise, if you don't market, and that affects your sales, right, then it should be in the cost of goods sold. If your advertising and marketing does not affect sales, then it shouldn't be in the cost of goods sold. But then the question that raised the question, right? Is it doing any good, right? Okay, only reason you do advertising and marketing is to affect sales. If it does affect sales, and if it moves the sales, then it should be in the cost of goods sold. So let me show you the next slide, next way. Look at it. So you got sales of 2 different products, and then you got net sales of 438. And then what I did was I broke out the material, right? Instead of looking at material as one lump, I dug in and found out what's the material cost for product 1? What's the material cost for product 2? What's the labor cost for product 1? What's the labor cost for product 2? And so on. What's the advertising cost for product 1? What's the advertising cost for product 2? Right? Because by the way, I just moved the advertising marketing to cost of goods. So that changed the margin from 32% to 25%. So that business is not a 32% margin business, it's actually a 25% margin business. So it's much less attractive, right? And then you got the overhead, same overhead, okay? So now it gives you a different indicator about the business. All right, so let me go even further, okay? I just broke out everything that's related to product 1. So I have sales of product 1, net sales, okay? And then I have all the cost of goods related to product 1, and the cost of goods is 270. And then for the product 1, the gross profit is actually 47,500, which is 15%. Okay. So let's look at product 2. I put all the costs related to product 2, right? Material, labor, freight, advertising, and product 2 gives me gross profit of 52%. Okay, ladies and gents, what did you just learn? Okay, okay. Right. Okay. So here's the thing. Remember, the financials are designed by your bookkeeper and your CPA for paying taxes and paying bills. As a business leader, you need intelligence for decision making. So the original financial statement gave me some intelligence, but was limited. Okay. The last financial statement is exactly this. I mean, it has the same content as the first one, but it gives me so much better intelligence. Does that make sense? And then many of you are saying, well, we got to do more product two, right? The reason why you can say that is because you have intelligence that gives you clear indicator of your opportunity, right? So that's the power of your financial statement designed, right, for the leader, designed to give you intelligence so that you can make decisions quickly and effectively. Okay? Yes. All right. Okay. Any question on this? Okay. So why financial statements? Because you have limited resources of dollars, time, employees, and so on. Because you're trying to achieve an objective. You're trying to go somewhere that's worthy, and you want to increase the value of your business. Again, so income statement, you got sales, and then your cost of goods, take some of that. Your operating expense, take some of that, and hopefully you have enough to enjoy, right? And to, as one of the other ones said, you can reinvest in the business, or you can take it as part of your rewards of working hard as a business owner. All right. So let's do an exercise. All right. Okay. So this is a family practice, and I want you to put together a P&L for the month of January. So I'm going to give you the details. All right. Here's a detail. I want you to take a paper and pencil. I want you to put together, right, January's profit and loss statement. Okay, the scenario looks like this. Family practice, perform 100 medical exams at 150, which includes $15 in medical supplies. They have a PA who is paid $2,000 a month, directly related to the exams. So this PA is a deal, right? Their payroll, not including the PA, is $5,800 a month. Lease payment, 19, taxes of 500, interest 300, depreciation of 1,000, phone book ad of 150. You know, I should change the update that now, right? That should be a Google ad. Insurance, utilities, each run $500 a month. What is the family practice's net income for January? I want you to show your work. So I want you to put together sales, cost of goods, operating expenses, and net income. All right, ready, set, go. You got 2 minutes. All right. Okay, let's take a look. Okay, so they perform 100 medical exams at 150 each, right? So that's 15,000. Your cost of goods sold is 2,000 for the PA, and then supplies of $15 times the 100 patients or 100 exams they perform, right? So your gross profit is 11,500. And then all the other overhead expenses. Payroll, 58, rent, taxes, interest, depreciation, advertising, utilities, and so on. Your total expenses, 10,650. And therefore, the net income for the month is $850. Okay. All right. So the reason why we're doing that is because sometimes we look at your financials and so how did we come up with those numbers? And so this is the background. This is kind of describing your business, right? And then everything you do affects your financial statement, right? Affects your finances, the timing of the spending, time of the receipts, right? Okay. Any question on this? Okay. Right. All right. So you know, when we in the last slide, so we had this number, this P&L, and maybe it's obvious to you about the performance, but very often when we look at the financial statement that look like this, so what do you do with it? What does it really tell us, right? And what action should I take based on these numbers? Well, in order to really answer those questions, we need context. So just looking at this one financial statement is helpful to some degree, but probably a limited degree. So we need something else to help us to know whether it is good, not good, and what we should do with it. So how can we bring some context to these numbers? So one way we can bring context is using something that's called industry average, right? So there is an industry average for health practitioners. You can get it online. You can get it free if you dig around in Google. So this gives you, on the average, what health practitioners' numbers should be. So let's put that against what we just did. So we had revenue of 15,000, right? Cost of goods, gross profit, operating expenses, and net income. And we put a percentage on these numbers, right? So cost of goods is 23%, gross profit 77%, and so on. So what does the industry average tell us, right? What on the average, how do other family practice offices, what kind of numbers do they generate? So industry average for cost of goods is 13% versus ours of 23. So theirs is lower, which means the gross profit for most other family practices are higher than ours because those numbers, cost of goods and gross profit go together. And then payroll, industry average is 32, ours is 38. Rent, average is 5, ours is 12, and so on. And then go all the way down, and our industry average net income is 7.5%, and ours is 5. So we're just bringing some context to know, okay, is this good, not good? What are the weaknesses? What are our strengths? So when we look at it, right, what it shows us is our gross profit is 10% lower than industry average, right? So there's something going on there, and our labor is higher, and our rent is higher, and so on, which all affects the net income, right? So industry average 7.5, we're at 5. So there's room for improvement, right? There's room for improvement. Okay, so before we leave this page, let me ask you, what's industry average? What's industry average? Well, no takers? Well, there's this word, right? Industry average. Thank you, Tracy. Right? It's average, right? Yes, right? It's for across the country, what's the average? So I know you're growing your business just so you can be average. Is that right? Right? No. So this industry average is really the bottom rung, right? You better beat the industry average because that's just average, right? So this number, right, is kind of the bottom rung. You want to do much better than the average, right? Yes. That's right. Okay, very good. So even at 5%, we know that's just not good enough, right? That's not even the average. So we want to be much better than the average, right? So, all right. So let me shift gears to next item, which is break-even point. So we just talked about really the P&L and what to do with the P&L. What does it tell us? Let's go into the break-even point. All right. Okay. What's break-even? What's break-even, ladies and gents? Okay, that's right. Okay. So break-even, when revenue generated from producing, selling just covers all the expenses of the company, right? Company has not yet made profit, but has reached a break-even, no profit or loss. Okay. All right. So the equation goes something like this. Break-even sales is fixed operating expenses divided by gross profit margin. That's the equation. How do you calculate break-even sales? Fixed operating expense divided by gross profit margin. So let's clarify what that is. So going back to the example we just had, what is the break-even sales for family practice, right? Okay, in terms of dollars. So I don't know about you. If you have a goal of sales dollars, I don't know, 10,000, 200,000, 300,000. If you have a goal of 200,000, I don't know what that tells you, but for me at least, I don't know how to act on 200,000. I don't know what to do to get to 200,000 when I have a goal that's a dollar sales. So it's much more helpful if I can convert that $200,000 into something that is more actionable, that I can get my hands around, right? So the other way to express what are the break-even sales for the company, for the family practice, is what's the break-even number of patients for family practice? So if I can convert the dollars into number of patients, now I know what to do with that, right? Okay, so that's what we're going to do right now. So as we discussed, as we saw, this is the P&L, right, for the example we just did. So break-even equation is fixed operating expenses, right? Fixed operating expenses, that number, divide by gross profit margin, right? Another way to say, okay, keep your eye on the screen if you would. So the break-even point is when this gross profit number, this number is exactly this number, right? Because when that number and that number is the same, you got zero here. Okay? So when that number equals that is zero, that's the break-even, right, point. So here's the thing. Another way to look at it is, okay, give me your eyes on the screen. So for every sales, right, for every sale, to deliver on the sale, it costs me 23%. So whether I sell 1 or 100, every sale costs me 23%, right? 1,000 sales cost me 23%. So that is the cost of delivering on the sales. So as the number goes up, right, this remains the same. As the number goes down, this remains the same, which means for every dollar I sell, only thing I have left to cover my overhead, generate profit, is the 77%, right? Because it always costs me materials and direct labor to deliver on the sale. So I only have 77%. So in order to figure out the break-even point, I take what's left, right, after cost of goods, and put that against total expenses, gives me the break-even sales. All right, so 10,650 divided by 77% gives you 13,831. So another way of saying is, at sales of 13,831, this gross profit is 10,650 and gives you zero net income. Okay. All right. So that's dollar sales. Okay, ladies and gents, how many patients does that represent? Because that's much more in our realm of decision making, and we'll know much better what to do with that. So break even, number of patients, right? How do you calculate that? You take the sales, and remember, it's $150 per patient. Sales minus 150 gives you 92 patients. When you see 92 patients, that's your break even, which means you've covered all of the overhead. So ladies and gentlemen, let me say that again. At break even point, you've covered your overhead. This has been covered. At break even, this has been covered. Okay? All right. So with that in mind, how much do you make from your 93rd patient? Okay, put it in the chat. Okay, yeah, I see 100%, 77%, 115, 135. Okay, good. Okay, so remember, the overhead's been covered, right? By the 92 patients, right? At 90 patients, overhead's been covered. And then for every patient, it still costs you 23%, right? Every patient costs you 23%, because you have the direct labor, direct material. So at 93rd, how much do you make? 77%. Isn't that amazing? Okay, 92, you make 0. On 93rd, you make 77%, right? That is right, 11, right? That's right. That's right, $115. Yes. Okay, good. So so why do we care about break even? Because really, when you get past the break even is when you really begin to generate profit. Okay, very good. All right, so we're gonna do an exercise. You ready? So it's called John's Food Truck. John runs a food truck that serves breakfast, lunch, and sandwiches, coffee, and soft drinks. Over the 6 months, average sales has been $10 per ticket. Average cost of ingredient, I made it really simple for you, $6, right, per sale. John's average monthly fixed operating expenses is $3,000. Okay, here's what I want you to figure out. What is John's gross profit for each sale? That's $1. What is his gross margin? What does John's sale need to be to break even? What's the break-even number of customers? And then he operates business 6 days a week. How many customers does he need to serve each day to break even? Right? You convert that from month to day. I gave you 6 days a week, 4 weeks a month, and then there's an extra credit. All right. I'm going to give you 5 minutes for this. Hey. Wow, I'm seeing some good numbers, good answers. Okay, so let's take a look. And I just wanna, okay. I know it's probably for most of you, it's been a long time since you've done exercise like this, but I appreciate your diligence. So let's take a look at this. All right. So again, John runs a food truck. Average sale is 10. Cost of ingredients is 6. So what's the gross profit? 10 minus 6 is 4, right? So gross profit is $4. What's the gross profit margin? $4 divided by 10 is 40%, right? Okay. So what did John's sale need to be in order to break even? His overhead is $3,000. So remember the equation. you only have 40% left. 60% is already taken by the material, right? And the labor. So you only have 40% left to cover all your overhead. So overhead divided by 40% gives you $7,500 per month. So, okay, that's nice to have a dollar figure, but can I change it into something I can act on? How many customers does that represent, right? So that's pretty simple in this equation. It's $10 per customer, right? That's the purchase. So 7,500 divided by $10 per customer gives you 750 customers. Okay. So he operates this 6 days a week. So how many does that represent per day? I need to know whether I'm winning or losing every day. I have a goal. I want to know every day how I'm doing. So you convert the 750 over 4 weeks, 6 days a week, and that gives you 32 customers per day. It takes him 32 customers to break even, right? After that, on the 33rd customer, right? On the 33rd, his overhead's been covered. So he has 40% of that going straight to the bottom line. All right, extra credit. Calculate break even if he wants to make $3,000 a month in profit. Actually, it's a very simple equation because you already had $3,000 for overhead and you figured out how much sale he needed to cover $3,000 of overhead. If he wants to make $3,000 in profit, you just add $3,000 to the $3,000, right? So $3,000 in overhead plus $3,000 he wants to make a month, divide by the 40%, gives you $15,000 in sales, okay? Now, can I convert that into number of people? Divide by 10, and that gives me, I don't know, this should be 1,500. 1,500 divided by 6, divided by 4 equals, right? It should be 64 a day, right? I don't know where that number came from. It should be 64 customers per day to make $3,000 in profit. Okay. Any question on that? Okay. All right. So good. I mean, I'm liking what I'm seeing on the chat. You guys are making progress. Those of you who didn't get it, keep working at it even after the webinar. All right. Moving on to the next one. So we talked about P&L and how to actually convert it in a way that gives you intelligence for making decisions. We talked about break even because it gives you really a mile marker to know what it is you need as a business to cover the overhead and then begin to make good profit, right? And then now we're going to move into projections. Projection, right? Income statement projection is projection of the future revenue expenses over a set time period based on past performance, because you have a sense of what what the costs are and what it takes to generate profit, future known events, compelling goals, and this is commonly called financial plan, right? For me, so here's what I say. So people make projections and have these kind of financial plans. And then usually what happens very often is they do it and then it get put away and then they go back to doing the things they've always done. So then their behavior doesn't change, which means they don't reach the goal. And if they hit the goal, it may be very often something they would have hit even without developing the plan. So there's momentum. I'm suggesting a goal that you would not hit doing it the way you've been doing it, right? So it would force you to change the way you're doing things in order to achieve a goal that is worthy. And if it's a worthy goal, it's a non-negotiable goal. So it's a goal that is must do, not a nice to do, right? Okay, I suggest that's the kind of context you want to be looking at when you're doing this kind of projections. So, all right, so we are going to do another exercise, right? Okay, so I'm giving you the same scenario of the family practice, okay? So, but there is a shift. They expect, so we did the January, now we're gonna go out 5 months. Practice expects increased number of patients they see in 2022 by 20 patients a month beginning April due to increase in advertising budget, right? Advertising budget down here increased by $350 a month in February. When they begin to do that, February, March, they begin to see the results in April. They'll be doing 120 medical exams per month beginning in April because of this increase, right? Expect medical supply costs per patient to remain the same. Do not expect to increase the PA salary. Wow, that PA is such a bargain. They'll need to hire one additional office staff in April at $24,000 annually. That's another bargain, and which includes payroll taxes. Depreciation is expected to stay the same. Utilities are forecast to rise due to increase in oil, natural gas cost. So they're expecting $100 increase in utilities a month in April. We increased advertising budget by $350 a month in February, and so on. What's the family practice income projection for the first 5 months of 2022? Okay, so, all right, I want you to take out your paper and pencil, okay, and I want you to work it out. And so you have 5 months of columns. January is the same, exactly what you had, and then you got to move it out to February, March, April, May. And things are beginning to shift a little bit because of advertising and cost of some of these costs that are going up. All right, so you got 5 minutes. Okay, let's take a look. All right, so this is the same example. We're just projecting it out 5 months, right? We already did the January, so we're going to do February, March, April, May. So the family practice expects to increase number of patients they see by 20 a month beginning in April, right? So it starts with 100 patients at 150 per exam, right? 100, and then in April they go up by 20, so now it's 120 patients at 150. So it goes from 15,000 to 18,000, 18,000, right? And then the cost for the goods, cost of goods for exam remains the same. 2,000 for the PA, and then $15 per exam of material. So 3,500, 3,500, 3,500, but you go up by 20 people, so it goes to 3,800, 3,800, right? And then you have gross profit of 11.5 until you get to April, then it rises to 14.2. Okay, now the expenses change a little bit, right? Your payroll goes up by 2,000 a month because you hired somebody in April, right, at 24,000 a month. Your rent is the same, tax is the same, interest the same, depreciation is the same. Advertising goes from 150 to 500, which is why you are getting the increase here in April, right? Hopefully it was a good advertising. So 150 to 500. Insurance goes from 500 to 600 in March. Utilities goes up by 100 in April, right? And therefore, your expenses go from 10,650 to 11,100, 13, and so on. And therefore, your net income goes from 850 to 500, 400, 1,000, 1,000. Okay. Any questions on this? All right. So what we just did is almost like a reactive scenario planning, right? So your insurance agent told you certain things, and then you talk to your marketing person, and we're going to increase the budget. Hopefully, it'll go up. The number of patients that's coming in, and then therefore, this is kind of what we think we're going to get. So this is very common way to do projection, but the way that we suggest you do is a little bit different. What we suggest you actually do when you're doing this is actually set the goal first, right? Remember, what's the measure of excellence for all businesses? Okay. So instead of letting net income kind of happen, right? I'm suggesting you set the goal that you want. Yes. Thank you. Yes, set the net income goal, and then you drive the actions, the activities that will get you to the net income. And that's a different way of really approaching your business, right? Okay. Because the moment you set the net income, and let's say you set a net income of 50,000 for the year, and then you break it up by month, right? And then that may tell you you have to do 4,000 profit a month, let's say. Okay, now you're in trouble because now you have to figure out, how do I generate 4,000 profit a month, right? Not just marketing to generate sales, but it has to affect everything to generate 4,000 in a sustainable, healthy way, right? So I'm suggesting you begin with a goal first. Remember the reason why most strategies don't deliver is because we begin the strategy by planning. And I'm suggesting when you begin with a goal that is worthy, you have a much better chance of doing the right things, hard things to gain the goal that you want. Okay, all right. So we just did a goal P&L projection. Okay, all right. Let's shift from P&L, right, profit and loss statement, to cash flow statement. Okay, let me ask you, how many of you have cash business? In other words, you don't give net 30 terms to customers. When they buy from you, they pay you cash, right? How many of you have cash business? Okay, thank you. All right. Okay. So very few of you have cash business, which means most of you have this problem, right? And the problem is, this is, I hear so many times, my business owners, they say, my P&L says I have profit. My bank account says I don't have cash. What's going on, right? What's going on? Well, this is gonna kind of uncover, really what's going on, right? Cash flow statement. What is that? Different from P&L, income statement. Cash flow statement purely looks at cash coming in from sales and borrowing, and cash going out from expenses, and you're buying equipments and so on, investments. Cash is the blood in the circulatory system of your business. Only irreparable mistake in business is run out of cash. Almost any other mistake in business can be remedied in one way or another. But when you run out of cash, they take you out of the game. All right. So areas that impact cash, operating expenses, right? Because you got to pay. Cost of goods sold, because you're buying stuff and you got to pay for labor. Receivable. Okay. How many of you have accounts receivable that is 30 days or longer or older, right? Okay, if you have 30 days or older, that means you're playing bank. That means you are playing bank. And I hope you have lots of deep pockets because not many small businesses can afford to be banked, right? Yeah, so receivables, that should be current. Payables, right? You don't want to be disrespectful to your partner, your vendors, but if they give you terms, you should take it, right? And inventory turns. If you have a business that has inventory, how often do you turn that inventory, right? What that means is, if you have inventory, if you have sales of 200,000, you have inventory on the average of 200,000, chances are you're turning that inventory once a year. That's not a very effective management of inventory. I believe Toyota turns their inventory over 50 times a year. Because every time you turn inventory, right, you get to generate profit out of that, right? If you only turn it once, you only get one chance to make a profit. If you turn that twice, you have two chances. 10 times, you have 10 times opportunity to generate profit. So you want to turn that inventory. All right. So no cash, no business. So here's a cash flow projection that is different than the P&L projection we just did, right? It's a projection of working capital need of a business over a set period to meet business goal, right? And we talked about that. So we're taking the example we just did, right? The family practice example, right? 100 patients a month, and then it increases in April and so on. But what I didn't tell you, right? What you did not know, because we're looking at P&L, now we're looking at cash flow. What I didn't tell you is 20% of your customers pay in cash or credit card. 40% are Medicare, and they pay in 60 days. Oh, your bank, right? And then 40% Medicaid, that's 90 days, right? And then you got expenses, less depreciation, because depreciation is not true expense. The depreciation is if you bought, let's say, some large equipment, 40,000, IRS allows you to spread that cost over multiple years to reduce your profit so that you can save, so that when that particular equipment wears out, you have savings to repurchase a new one, something like that, right? And then you got wages and cost of goods sold. All right. All right. So you need a billing company that guarantees 30-day payment. Well, I can tell you, not all billing companies are the same. There are some who are much more diligent and thorough. And of course, you have to ask around, shop around to find those. Okay, let's put this together. So we have sales of 15,000. I'm taking out the increase. I'm just keeping it simple, 15,000 a month, right? Okay, but that's what you book as sales in P&L. But here's the thing, what you have collected, okay, 20% of that is in cash or credit card, so that you get 3,000, okay, minus the credit card fee. And then your collection on Medicare is in 60 days. So you do the work, you don't get paid until 60 days, you get 6,000, right? Okay, and then Medicaid in 90 days. In 90 days, you begin to get collection from Medicaid. So 6,000 to 12,000, 12,000. This is cash coming in now. All right. So your cash receipt or net cash position is 3,000 in month one, 3,000 month two, 9,000, 15,000, and so on. All right. That's what you have in cash. Let's talk about expenses. Your cost of goods sold, that's your PA, and your $15 per exam is $3,500. And then your wages, right? $5,800. Okay. And then your operating expense of $3,850. So your cash position, 3,000 positive, and then this is negative, right? And so net cash position in month one is negative 10,150. Month two, same thing. Month three, because you got some collections, so it's only negative 4150. Month four, it's now finally getting to positive, all right, because you got the 12,000 and more positive. All right, but that's by month. Let's look at the net cash position. Net cash position. First month, you are negative 10. Second month, another negative 10. Combined, you got negative 20. Another negative 4 in month 3, negative 24. Month 4, positive, so it begins to get down. So another way to say it, let's say this is, you're starting a business. And I know most of you are not. You're starting a business. How much money, how much cash, let's say, operating cash, do you need to start this business? Okay, just purely from this cash flow statement. How much operating cash do you need to start this business? Right. Okay. Because you need at least, this is the bottom, right? At least 24,450. But you know, this is a projection. So you want to make sure you have some reserves, right? Okay. This does not include all the other startup costs. So this is also true if you have an existing business and you want to start a new practice. You want to start a new branch. You want to offer a different product or different service. You have, you know, so this helps you to figure out, okay, what do we need to be able to grow that business, right? Okay. Any questions? Okay. All right. Okay. So we're done. We're done. So we covered P&L, talk about sales and different kinds of sales. Talk about cost of goods. Talked about gross profit, talked about gross margin, talked about operating expenses and net profit, break evens, right? And then we talked about projections, right? Setting goals. And then we talked about cash flow projection. Now I want to talk about discounting. All right. Now I want you to fess up. How many of you feel pressure to discount? Okay. 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 Yes. Thank you, Elizabeth. Good. Okay. So this is the, you know, I mean, I would say most small businesses feel some pressure to discount, right? And it just feels like everybody's about price, right? Okay. And so, and every once in a while you may give in and think, what's the harm in a small discount, right? Okay. So I wanna kind of walk you through the impact of discounting so that your reaction to that pressure is not severed from the goal you're going after, right? You have a congruent approach, right? So discounting, especially when the sales declines, or you may have a big job and things like that, and you know, and so you may feel that. So what happens to volume and margin when you discount prices? So I'm going to give you a chart, all right? So this is about impact of discounting on volume and gross margin, right? Okay, so let's say you have a 30% gross margin business and you go, okay, well, you know, that customer, we really want that job. We really want that job. So we're going to discount 10%. Okay? What's 10%? You know, oh, you see so many people doing 20%, 30%. What's 10%? So what this shows you is if you have a gross margin business of 30%, you discount by 10%, you would need to increase sales by 50% in order to get to where you were. Not get ahead, get to where you were. Okay, so let me show you in this example. All right, so let's say you are selling something for $250 and you're selling about $3,000. Your sales, therefore, is $750. Your material cost $307, labor is $217, your cost of goods is $525, your gross profit is $225. And then you got operating expenses, and your total expense is $225, and you are at virtually break even. Okay? And you feel pressure because you don't want to lose out. You don't want your sales going down. So you feel pressure, so you decrease. You cut it, you give discount by 10%. Okay? So price has gone down by 10%, right? And you want to maintain the same volume, 3,000. So your sales down from 750 to 675, but your material cost hasn't changed because you're selling the same amount. Your labor hasn't changed because you're selling the same amount. So your cost of goods is 525, but your gross profit just dropped from 225 to 150. You have same level of overhead. 150 minus 224 gives you a negative 74, right? Okay. Now, how much more do I have to sell in order to get back to where I was? So sale price down by 10%. You increase the sales by 50%. So 3,000 to 4,500. And let's see what that does. So you just sold $1 million worth, right? Because you increased by 50%. But because you increase the sales of units, your material cost goes up, labor cost goes up, so your cost of goods is 787, all right? And then you end up in the gross profit of 225, same overhead, and you're back to where you were. Okay. Okay. So what's 10% discount, right? Okay. So depending on the margin that you have, it could put you in a pretty severe position if you don't know, if you don't really think it through of what it's going to do to your bottom line. Okay. So we're not saying you don't. Well, we prefer that you don't, but we just want to open your eyes. Okay. All right. Let's look at a little different scenario. What if you increase price? Right? Okay, what if you increase price? So same kind of business, 30% margin business. You, instead of giving a discount by 10, you increase price by 10, right? And what does this mean? You can handle shrinkage of 25% in business and still get to where you were. Okay, let's look at that. So your current price 250, you're selling 3,000, and you got the same scenario, right? Virtually break even. What if you increase price by 10%? So increase 10% to 275, right? And so some people say, no thanks. So your sales shrink by 25%. So your sales is down. But your material and labor may go down. So you have 393, to generate the gross profit of 225 to get to where you were before. Okay. We just want you to see the difference, the impact of discounting, but also the impact of raising prices, right? And obviously, one of the things raising price will do is people who are price sensitive will go away. So many businesses, when you're starting out, when you're trying to enter a new market and so on, very often people go with low price, hoping to buy market share. But the challenge with that is you will probably attract people who are price sensitive. And then you'll find out that there isn't much future at that level of margin. It's hard to really generate much profit, hard to pay your employees well, hard to invest in your business, hard to generate capital for growth. So at some point, you're going to have to say, like so many we see, okay, I can't continue this way. I need better margin. So you increase price, and then all those price-sensitive customers you thought you could grow with will go away, and you'll have to go find new ones, better ones. So rather than going through that way, right, solve a meaningful problem with a compelling solution, deliver a win, right, find people who will appreciate that, and you'll have margin, profit, sustainability. All right. Okay, so grandfather clients. Well, I think that time is over. So why financial statements? Because you, like Amazon, really, Google, Boeing, right, Microsoft, GE, GM, HP, all have limited resources, right? Which means every dollar count, every hour count. and you want to leverage that limited resource, right, to get the biggest gain you can. And because you are going after a objective that's going to be better than where you are now, right? And because at some point you're going to exit, you want to create wealth and value in your business so that when you exit, right, you can retire well, right? So that's why. Okay. So one of the things I just mentioned is when you are using financials, not only are they intelligence that helps you make better decisions, but when you set a goal, right, it shows you the progress you're making and the things you may have to do to actually achieve the goal. Remember, when we look at a P&L, it doesn't do much good to just look at a P&L unless you have context. So we looked at the context of kind of national, maybe the industry average. The other context may be last year's performance of the same month, previous month performance. Those are context. But probably the best context is the goal, right? What goal did you have for the month? And then how did we actually do against the month? So when you look at your financials, you have your goal, and then you have the actual, and you're looking at it and saying, okay, what's working, what's not? What is this showing us? What weakness do we need to fix because it keeps rearing its ugly head, right? Okay, what are we doing really well, right? And so on. So we're suggesting that it'll be helpful if you have goals that's expressed in the financials. And then every week, okay, so remember, financials must be accurate and timely. So if you're looking at your financials once a year, not good enough. If you're looking at it once a quarter, not good enough. As a small business, you can't let that much time go. If you're looking at it once a month, it's not bad, but month is a long time for a small business. Your benefit, your strength is speed, right? You can't wait a month of bad decisions or bad operation. So I'm suggesting you look at it at least once a week, right? Once a week. Now, if your CPA can't produce that for you, time to look at alternatives. If your bookkeeper can't produce that for you, right? You gotta figure out how do we make that happen, because you can't let those things stop you from building a great business. You need that intelligence that's accurate and timely so that you can respond to it quickly, right? Right. So setting financial goals, right? Based on objective, right? Your plan is based on objective, the destination. Reflects strategy, priorities, activities, timeline, assumptions, right? And then you want to actually keep your eye on it and you're making adjustments. And you're all familiar with SMART goals, right? Specific, accurate, attainable, time-bound. This is really a no-brainer for financials because when we are looking at financial goals, I'm suggesting you begin with net income because that is the measure of excellence, right? That is the measure. So when you set a goal, it's non-negotiable, right? You don't get to say, oh, we missed it. That's not a goal, right? That's a suggestion. That's a dream and a wish. When you set a goal, it's a must-do. And then you're going after it because you are leaders. Okay. Right. So based on what you learned today or what you heard, okay, I'm suggesting before you leave, because the moment you leave this webinar, all those pressures of a business is going to come to just distract you, right? Preoccupy you. So before you leave, I'm saying, take time now to consider your goals, consider your actions, right? Okay, what is it that you need to do? for 2022? What do you need to do for 2023, right? Okay. So, okay, any questions? Okay, good question by Sarah, right? Sarah is asking, the financial statement is only as good as the input, right? So, Sarah, this is because this is a challenge for every business, right? And the reason why this situation exists, right, what you just described exists, is because most leaders don't know what they want, right? Because you've never considered that financial statement is primarily for you. Did you know that? It's not for your CPA, it's for you, which means you have to tell everybody, right, who is working on it, what you want, how you want to see it. And then as you begin that journey, you'll figure out where the needs are, right? Where the fuzziness is. So it may be you are not collecting, for example, for every project you do, your employee may not be clocking in their hours. So you don't have accurate data. So it forces those issues up so that you can say, okay, we need to know our performance, and therefore we need those labor hours inputted, right? Every time somebody works on a particular project. Okay, same thing with, accounting cost, marketing cost, shipping cost, and so on. You will begin, when you are clear on what you want, you will begin to see the gaps and you will address it with your team. Okay, so when should you start paying yourself after you break even? Okay, good question, right? Really, so here's what I suggest. If you're an owner, you're a worker, you should put your wages in your business because, right? Because really, you're not working for free, because at some point when you grow, somebody else is going to have to do the work that you're doing and you have to pay them. So that actually, the work you're doing is actually cost of doing business. If you don't charge for it, you are underrepresenting the actual cost, right? So I suggest you put your wages in there from the beginning. It may be you can't pay yourself because you're in the negative. Nonetheless, you are reflecting the reality of the business, right? Okay, so obviously you can't pay yourself unless you are producing profit, right? Okay. Okay, any other question? Prior to opening, how do you put all the numbers in place? Okay, so really, when you are, for those of you here in business, this is probably not that meaningful, but if you're starting out, there's two kinds of business. There is the startup cost and there is the operating cost. If you have an ongoing business, your startup cost is already taken care of, right? But for a new business, you have startup costs. That may be leasehold improvement, buying equipment, right? Signage, right? You have to hire people ahead. You got to train them. All of those costs are startup costs. And then moment you open, right, and begin to generate sale, that's the operating of the business. So you want to know how much does it cost to actually get the business started and all that separate cost. And then you got the operating costs, which you can, Tracy, you get that from your sister in her business. You can generate that. But the startup cost, you'll have to figure that out. If you're building a building, obviously that's part of the cost. And all the purchase of new equipment, inventory, yeah, you have to make that list and figure out how much that's going to cost and make sure you have enough, not only start the business, but to sustain it. The other part that is different for all of you in North Idaho, most of you are in a seasonal business, right? So when you start is so important, right? If you have a seasonal business, September, October is probably not the time to start, right? Unless you have a winter business. You really want to start early in the year so that you get the benefit of the summer, right? And so the time frame is important for generating cash and reserves to sustain you through the difficult winter times. Any other question? I just want to say you guys were so diligent, right? I know it's not easy doing those exercises, but I saw all of you working hard, and I think you know, as you work on it, and maybe you didn't get it all right, but you kind of got the gist of it. So the more you get your hands into it, and more comfortable you get, you realize it's not rocket science. Millions of people use it every day, and you are smarter than most of them. So really, don't let the mystery of the words or vocabularies stop you from getting really good at it, because if you want to lead well, you got to know the numbers. Okay, everybody. Thank you for being here. All the best to you in your business. Oh, just one more word. Take the rest of the webinars. Many of you think you only need one thing, but I'm suggesting, right? You need to ask better questions than maybe you're asking. And the operations, that's about systems and processes. Managing people, leading people is so crucial in this season. Digital marketing is massively important. So I'm suggesting, well, especially now while it's free at no cost to you, jump in there, take it, learn, grow, so you can lead your business more effectively. Okay. All right. All the best.